My plan is to address inflation. It starts with a simple proposition. Respect the Fed. Respect the Fed's independence.
It is extremely important to work on the possibility and to explore the possibility of import price caps also with international partners.
You have to look at where new production is coming and where would be coming even if we didn't have $123 Brent. And I'd say it's more in the $70 range than it is in the $120 range.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Wednesday, the 1st of June. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Deflecting blame while President Biden backs the Fed's efforts to tackle price growth, putting the onus on Jay Powell. Janet Yellen, meanwhile, says she was wrong on inflation. Eye on supply, oil edges higher amid a report that OPEC Plus could exclude Russia from its production targets. And Deutsche Bank replaces the CEO of its asset management arm after yesterday's police raid over suspected greenwashing. Stefan Hoops is DWS's new chief executive. Now, first thing is first, let's check on the markets. We actually started the day on a high. Now we're seeing quite a lot of fluctuation. It's a pattern that we also saw in Asian stocks. If you look at yields, probably one of the most interesting dynamics, extending their advance. And of course, the debate is about the scale of monetary policy to deal with inflation. It's a debate that we have day in, day out, and that moves everything. We're speaking to Grace Peters of JP Morgan Asset Management, and she says if there's one thing you need to get right in this market, and it's inflation, and that will give you, of course, the cue to buy or sell whatever you want. The dollar, of course, that's also linked to inflation. We have the Bloomberg US Dollar. We could have also shown you Euro Dollar or anything else showing the dollar rally in the last couple of months. That's come off a touch, 1,228 from the Bloomberg US Dollar Index. Brent crude, again, this is not something that we need to talk about theoretically. This means gasoline prices are going up. This means a lot of the cost of living for a lot of people out there is really hurting them. This could also politically have a huge impact, of course, on some politicians in charge, and then the S&P futures gaining some 0.2%. This is a picture overall for Europe, but we're also just getting some manufacturing data. I think that came out a short while ago. The difference, if you're standing in Italy or in Germany or in the CAC 40 today, you can see gaining some 0.3%. The UK also, it is the platinum jubilee of the Queen, 70 years on the throne, so we'll celebrate. The bunting's out for tomorrow and Friday, but it will have an impact on economic growth. And you can see the UK, for the moment, the FTSE down 0.1%. Now, the rally in oil prices has fizzled. That's after a report that OPEC members are exploring the idea of exempting Russia from its production deal. At the same time, Joe Biden has sought to shift blame around price rises to the Fed. The U.S. president says he respects the central bank's independence.
My plan is to address inflation. It starts with a simple proposition. Respect the Fed. Respect the Fed's independence. They have a laser focus on addressing inflation, just like I am. And with a larger complement of board members now confirmed, I know we'll use those tools of monetary policy to address the rising prices for the American people.
Now we're joined by Sylvia Merler, head of policy research and ESG at Algebris, and Noor Al-Ali, our MLive editor. So thank you both for joining us. Noor, a lot going on with OPEC. I mean, I haven't been this excited about OPEC Plus meeting, but has it peaked?
I'm in the camp that is cautiously saying yes, because if you look at inflation expectations, so those are break-evens. If you look at the five-year, which is the Fed's favorite inflation gauge as well, you will see that they've actually come down off their highs and they've sort of stagnated now. Those, they don't typically move in line with oil, but they have been because energy has been a big supplier and mover of the hot inflation prints that we've seen. They've kind of diverged now. So the question is, are inflation expectations wrong or has oil peaked? I'm in the camp that says, well, maybe we've just peaked. Okay, we've peaked. I'm interested to have Sylvia's thoughts on that in a second. But QT also begins today in the U.S. or begins in the U.S. today. What does that mean for riskier assets? You know, I think we've priced in that beginning of quantitative tightening. You have seen definitely, you know, stocks come on the highs today. The futures are higher, but also I'm a believer in the mantra of sell in May and go away. I think you know, volumes are much lower now. If you look at the stock 600, it's, you know, the average volume is about 20% lower than its 180-day average. So definitely much lower now. So
Sylvia, many questions, of course, about the markets, about how we should look at them, inflation. What are markets at this point you think getting wrong?
So I think basically what we have seen today, I think one detail that perhaps you have not mentioned yet was the data coming out of Germany on retail sales. I found that was quite important. So a very significant miss on the downside on retail sales in Germany, even considering the inflation rate that is very high in Germany. And I wonder whether that signals that at least in some quarters of the Union in Europe, at least we are getting close to a scenario where inflation is sort of self-inducing a correction in the economy without the ECB having to force its hand too much.
Yeah, and the ECB, nor of course left, right, and center. I mean, how behind the curve are they?
Well, you know, as we just heard, definitely some data out of the European Union shows that we are definitely struggling. France expects inflation to, you know, go behind its peak in 2023. We are seeing elevated inflation prints. They will continue to be the case in Europe, and it will lag, you know, the US and the UK as well, because we haven't even started raising rates or quantitative tightening in the ECB.
All right, Nora, thank you so much. I know Nora has to run off to radio, so we'll continue the conversation with Sylvia. Sylvia, when you look at, you know, we're hearing and getting some headlines from Mr. Holtzman on the ECB Governing Council, and he says the new inflation record backs the need for a 50 basis point hike. Is the, you know, I guess, has the ECB now, you know, boxed themselves in being so behind the curve, and what does it mean for fixed income across the board in Europe?
I mean, we have definitely held this view that the ECB was behind the curve on inflation, but honestly, that's something that's common across major central banks, as being common across major central banks. I think what is different so far still in Europe compared to, for example, the situation in the US is wages. So there isn't much that a central bank can do when it's faced with a supply shock, the kind of the shock that we're seeing now. The choice is between hiking immediately, so trying to rein in inflation fast, or sort of wait for inflation to induce a correction in the economy with obviously an impact, much bigger impact on purchasing power in the meantime. I think that the answer to that question depends on whether you think inflation is going to be sticky or not. And a lot of the answer to the second question depends on wages. And so far, I think that's the main difference between Europe and the US. In Europe, we haven't yet seen the kind of wage dynamics that we have seen in the US. So far, I think there's still room for, let's say, maneuver and the kind of ambiguity that we're seeing on the ECB side, but that may be closing fast.
Sylvia, what does it mean when you look at, of course, wage pressure? If we're going to see that kind of wage pressure in Europe, do you see it in Germany first, or does it come from elsewhere?
Yes, I would assume it would probably show up in Germany first because of the significantly higher inflation rates that we are observing in Germany. So that is the market, the labor market, that I would keep a close eye on.
All right, Sylvia, thanks so much. Sylvia Merler there from Algebris stays with us. Now, we'll have plenty more, of course, on the markets. Also coming up, the CEO of DWS Group resigns just hours after police raid on the asset management unit of Deutsche Bank. So we'll have plenty more on that story next. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the chief executive of DWS Group, Shelby Khan, has resigned and will be replaced by Stefan Hoops. The announcement came just hours after a police raid on the asset management unit of Deutsche Bank over accusations of greenwashing. Well, joining us now is Bloomberg's German banks reporter, Steven Ahrens. Steve, great to speak to you. So first of all, why did Verman resign so quickly?
Well, there's been a lot of negative news around him for a long time. As you may remember, the whistleblower Desiree Fixler came out with allegations of greenwashing in August last year, and ever since then, news stories have popped up, questions about his private use of email, WhatsApp, stuff that, always created a cloud over his head. And then you have that big raid over greenwashing. And I think it just was the straw that broke a camel's back. Deutsche Bank decided they needed to draw a line under this, and he resigned.
So what do we know about the new guy in charge?
The new guy, Stefan Hoops, what's most important, I think, to know about him is he speaks very close to Christian Sewing, and Sewing, the Deutsche Bank CEO, trusts him a lot. He's been putting in different places when he needed someone to fix a unit. And so he's sort of a fallback solution for difficult cases. And now Sewing has turned to him to go to DWS. He doesn't have any experience in asset management, really. He's a trader by training, and we'll see how he performs. But he does have the confidence, the trust of the CEO of Deutsche Bank.
Steve, so how should we look at this? First of all, reputationally, but also legally. What does it mean for DWS and Deutsche Bank, and what does it mean for greenwashing in financial services in general?
Well, I mean, it's important to of course, state that this is just allegations now. Nothing has been proven. It was a raid to find further evidence, but the presumption of innocence still applies until they've been proven guilty. But it's clearly a new legal cloud hanging over their head. Greenwashing is something new, it's unusual, but what the prosecutor said in their statement yesterday is that they believe they have found evidence that DWS said something to investors in their funds about ESG that didn't actually take place. So misleading investors obviously can be a crime. And if that turns out to have taken place, it would be a big blow for DWS and by extension for the parent company, Deutsche Bank.
Thank you so much, Steve. Bloomberg's Steve Ahrens there covering banks for us in Germany. Now we're back with Sylvia Merrilayer, head of policy research and ESG, and Alger Bruce. Sylvia, you look at ESG, you take it very seriously. I know look at a lot of the policy research. Is this now a crux point for financial services to really understand how they cannot mislead? Do we have the tools to try and not make a mistake on this?
I think, yes, this is a turning point. I think it was in the cards that a lot more scrutiny would be growing on ESG and, generally speaking, sustainable finance. This was in the cards because the regulatory environment in Europe has been moving very fast on this, even though with some regulatory pieces still needing to come into place for us to have the full picture. And so I think that is where the risk currently is, in having a regulatory environment that still isn't complete and at the same time having to implement that in practice. Another element where we have written and where we think that regulation might be needed is the area of ESG scores and ESG ratings. This has been in the news recently, I think with Elon Musk complaining that Tesla was rated worse than some of the biggest polluters on the planet. I mean, that was obviously a very strong statement, but at the same time, it does point to a more general issue. So there is no standard, there is no regulation for these ratings for the time being, and so much is reliant on these ratings credibility and reliability. So I think that is also an area where we will at some point need and see some regulatory intervention to make sure that the instruments the industry is using to translate regulatory requirements in practice are really reliable and consistent.
Yeah, and Sylvia, are we seeing also, such things, we're talking about Europe, but are we seeing it across the world in Asia and the US to doing same, as ESG portfolios or certainly ESG products will become more prominent in a lot of these portfolios? How do you align everyone?
So I think that's really a question to which we yet don't have the answer. We know that Europe is the jurisdiction that's far ahead in terms of implementing all this regulation compared to other jurisdictions. I would expect everybody else to follow. It is not automatic that we will have alignment. If you look at developments in the UK, for example, on sustainable finance, they are to some extent aligned to what is happening in the European Union, but there are differences as well. I think one element that so far perhaps has been a little bit underlooked and will become prominent, especially in light of scandals like this one, is how active managers really are. So the engagement side of the ESG that is really, I think, showing what investors can do to leverage their power as investors to stay true to what they say they do in terms of promoting sustainability.
And Sylvia, to follow up on that, I know you've written extensively about the Russian oil embargo, but also the global food crisis. How should we look at the Russian oil embargo, and will a lot of this just be diverted to other parts of the world?
So I think, first of all, it's positive that this was agreed. I don't think it was, we got to a point where expectations had fallen so low that I think this is good news, the good news that the European Union could rally together and agree on an oil embargo, even if it's partial. I don't think it's the best deal that they could have found agreement on, but it's still something that shows unity. And that potentially, particularly with the inclusion of insurance and the deal between the UK and the EU on insurance, can put significant pressure on Russia, because insurance for Russian oil, also Russian oil that is shipped to third countries, so not just the EU or the UK itself, but everywhere else in the world, is predominantly done in the UK or in Europe. And so having this particular piece in the package, I think, is the most important signal that Europe can send.
And Sylvia, I mean, another which is not ESG, but also linked, of course, is, the global food crisis. Are we underestimating the impact this will have longer term? Are we too short-termists, short-termists when we talk about the markets day in, day out? Because this will have a huge, huge impact on the cost of living for years and decades to come.
I agree. This has been a concern of ours for some time. We wrote a piece in March highlighting the risk of a global food crisis and global food inflation due to disruptions that the war was inducing, both in the shipping of grains from Ukraine, but also in the future agricultural cycles. So the planting of the new crops, the tending of the crops that have already been planted and need to be harvested in the summer. And this is only part of the story, really, because when you factor in also the skyrocketing prices on fertilizers that are linked to the price of gas, this means higher input prices for farming across the board, not just farming in Ukraine, farming everywhere. And I think this is just the beginning, to be honest, because if we look at where in the world the impact will be felt more strongly, particularly for exports of grain in Ukraine, the areas that are going to be hit the most are very poor areas where there could be also episodes of political instability related to this. We calculated that a decrease of 50% in imports of wheat from Ukraine could reduce daily calories in some of the countries in the Middle East and North Africa by between 30 and 35% a day, which is really massive. And so obviously this is a crisis. It can be a crisis of major proportions. I think we have been underestimating it so far. And I think it also will be more longer term than many people might be thinking, because of how the agricultural cycles are relatively medium to long term. So the perspective here is really one of months, if not a couple of years.
Sylvia, thank you so much, as always. Sylvia Merler, their Head of Policy Research and ESG at Algebris, joining us this morning. Now, coming up on the program, China's factory activity falls at a slower pace than expected as Beijing doubles down on its costly COVID-0 strategy, and how the world's hunger for Russian commodities is fueling the Kremlin's war machine. We'll bring you our big take shortly. This is Bloomberg. Deflecting blame. Well, President Biden backs the Fed's efforts to tackle price growth, putting the onus on Jay Powell. Janet Yellen says she was wrong on inflation. Eye on supply. Oil edges higher amid a report that OPEC Plus could exclude Russia from its production targets. And Deutsche Bank replaces the chief executive of its asset management arm after yesterday's police raid over suspected greenwashing. Well, Stefan Hoops is DWS's new chief executive. Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Wednesday, the 1st of June. Yes, it's June, everyone. Hold on tight. I'm Francine Lacqua here in London. Now, the market's definitely struggling to hold on to some of the earlier gains. I'm looking at stocks in Europe, but also U.S. equity futures. They're trying to find their feet, struggling for direction amid this debate over the scale of central bank monetary policy tightening needed to fight inflation. I'm also looking at the dollar gauge advancing, again, on this Fed rate hike wager. And then I'm looking at yen sliding. S&P futures pretty much flat. Now, Canary Wharf Group has dubbed the Elizabeth line as a game changer for the future of London's second financial district. But with banks now accounting for less than half of the group's rental income, Canary Wharf is looking to a future beyond the big lenders. In fact, Europe's largest commercial lab is being built on a site once tagged to be Deutsche Bank's London headquarters. Well, we're now joined by the Canary Wharf Group Chief Executive Shobi Khan. Shobi, thank you for joining us. This is exciting. I mean, you're trying to regenerate Canary Wharf. The Elizabeth line was inaugurated a short while ago. How are you expecting it to change?
It's already changed. Thanks for having me this morning. We've seen traffic increase by 25 to 30% in the first week. Now, first week is not the year, but we've had a robust start, and people are now discovering new ways and avenues of getting to the Canary Wharf site.
But this is people that come in to spend. Is it tourists? What kind of, customers are you hoping to attract on site?
So, Canary Wharf historically has been known as a financial center, but we are now a truly vibrant mixed-use community. So we appeal to both office workers, residents now that live at Canary Wharf, as well as customers that are shopping. We've got a robust food and beverage offering. We've got over 80 cafes and restaurants at Canary Wharf.
Shobi, you sound like an ad. What will be the biggest revenue driver in the next 12 months?
Well, revenue driver, I think, well, look, we're still a financial center in the sense of the office, but we've now got the residential that is leasing up dramatically. We've got 5 towers that we've built up on the rental side. They're leasing up extremely well. Rents are going up, and so we've now committed to build another 4 residential towers.
So how do you revitalize? I love coming to Canary Wharf. Right? I mean, I'm going to put up my hand up and say, actually, every time I have an interview with, one of the big newsmakers in Canary Wharf, I hope it's a little bit later so that I can have lunch there. Not a lot of people want to spend weekends there. How can we change that?
No, that's not true. No. Our traffic, we average over approximately 100,000 visitors both Saturday and Sunday now. And I think the Elizabeth line, to your first point, will be even more significant because we've got all that growth coming from East London. They're coming now and experiencing Canary Wharf.
But you could do better. Is that fair?
We could do better, yeah. And we have announced a partnership with the Eden Project. Yeah. We're going to create a green spine through the middle of Canary Wharf. And so you're going to be able to go swimming, paddle boarding, play paddle tennis, rent a kayak, all these kinds of leisure activities. We've even created the electric go-kart race tracking in the garages now.
Do you need influencers? How do you get the word out there?
I'm coming on TV to kind of talk about it with you. But we're actively marketing, I think, to the community, and I think the Elizabeth line, to your point, will be a game changer that people now have another way of coming there, and then the connection to Heathrow is critical for us.
You are our original influencer, Shobi, certainly for Bloomberg TV viewers. Give me a sense of whether people are coming back to work and whether you see that going back to full-time. How has COVID actually changed, life at Canary Wharf?
Yeah, so I think, look, 2 points. One, we're in a hybrid world now, and each company's deciding what they want to do based on their culture. And so each company's deciding how they want to lay their offices out, what kind of technology they want, but they've realized that they need the office. They need the office to collaborate, to innovate, to mentor. And our job is to create an environment, an extraordinary environment for them, so when they do come and they're excited about coming, we've got a plethora of options for them to take hold of.
So what do people want? And have you actually been talking to banks or,
yeah, sustainable. Everybody wants a sustainable environment, and so we are actually the UK's largest sustainable developer. We've built over 10 million square feet of sustainable both office and residential. So great light, great air quality, filtration, access to green space, and then all the other things that I mentioned earlier about restaurants and health clubs, et cetera, movie theaters, providing that environment so when folks do come to the office, they have a great environment.
gyms? I mean, I imagine last 10 years what workers want has significantly changed. I mean, I used to go out to the pub in my youth. People now go for kale juice.
Yep. They go to kale juice. We've got third space. It's over 100,000 square foot gym there, and they've got so much demand. We're building another third space gym in the Wood Wharf area. So all that what you talked about, and everyone's got different interests. And so we've got the largest art collection in the entire country, public art, over 100 sculptures.
I did not know that. And that changes regularly, or is it
We've
fixed?
got some permanent collections, and then we do some annual things. So winter lights that we do in mid-January. Obviously, we haven't done it the last 2 years, but it'll be coming back this January. We do it for about 10 days. We get artists all over the world to come. In 10 days in January, we have over 500,000 people come.
So when you look at the COVID legacy, is that also, you know, do people dress differently? Do their office hours change? Have you seen any patterns that we should be focusing on?
Yeah, I think, look, you've got that Monday, Friday kind of elbow with Tuesday, Thursday, Wednesday. You know, Thursday's the new Friday, Wednesday's the new Thursday, so to speak. So yeah, I think, but I think each company is trying to determine that, and they'll figure that out. I think over the next several years, everyone's going to kind of figure out what their culture is for what they want to do.
So you're telling me that Thursday night is the happening?
It is.
Is it the big night out in Canary Wharf?
It is. It is. And you know, Hawksmoor just opened up a flagship restaurant. You have to book in advance now because you can't get a seat at a table now.
How do you attract the techies and the biotechs of this world?
So, great question. So we announced about a month ago that we're going to build Europe's largest commercial health lab building, 22 stories, 750,000 square feet. So that is going to be our first anchor that we will attract, hopefully, great companies in that field. But we've had tech, Revolut, that you guys know about. That started with 2 desks at Canary Wharf. And now they're over 80,000 feet. And so we've incubated some of those kinds of companies. Apple has moved to Canary Wharf. They've got some floors. So we're starting to get those new economy businesses coming to the wharf.
All right. So what's my ideal? What I'm coming for a drink. I'm going to a cocktail bar and then a Hawksmoor. Like
you're going to wake up in the morning and go paddle boarding. You're going to have a great green juice for breakfast. Go exercise and have a great lunch, and then go to Hawksmoor for a nice steak.
There you go. No work. That's it. We don't need to work. We just go and hang out in Canary Wharf. Shobi, thank you so much for coming on. Shobi Khan, the CEO of Canary Wharf Group. Now coming up, China doubles down on its costly COVID-0 strategy. We'll look at the economic impact next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, China doubling down on mass testing in a move that's dashing hopes for a shift away from the costly COVID-0 strategy. It comes as China's factory activity in May contracted from the previous month as both production and new orders fell, although the slowdown was not as fast as in April. Joining us now is Bloomberg Shanghai Bureau Chief Charlie Xu. Charlie, talk us first of all through what's happening on the ground with COVID.
Today is a really special day for Shanghai people. The 2-month lockdown has finally been lifted. It's a big move, for the government here. It's for the first time in about 2 months. Most residents are allowed to leave their residence and move freely around the city. I just came back from a trip in the shopping district on the other side of the city. Saw a lot of people, shoppers, and also traffic on the street. Crowds in malls and the subway. It feels a bit surreal after such a long time of confinement. Anyway, I think the general feeling is Shanghai is slowly coming back to life. Some curves are still, remaining, but there's so for example, there's capacity limit for some malls, for example, but things are slowly coming back.
So, Charlie, what's the latest on business resumption, and what does Shanghai reopening mean for the broader economy?
People can return, to return to work. You just need to, have a negative PCR test result, valid. The test must be done within the past 72 hours. If the test result is negative, you can go back to office to work. And we heard from traders and bankers, fund managers. They are, gradually returning to the office. Not all of them overnight, but they are going back to their office. And of course, some companies are, told us they still can't fully restart the operations. despite the easing because of supply chain issues. After all, there's been disruption to supply chain production, for 2 months. It takes time to repair. Yeah. For the economy, I think there's a lot of uncertainties because the Omicron risk is still there. If there's outbreak, there will be more economically disruptive lockdowns.
Yeah, and we're speaking actually to the chair of the British Chamber of Commerce in Shanghai, who's saying there's also a lot of international foreigners, of course, that are leaving the country. Thank you so much. Our Bloomberg Shanghai Bureau Chief, Charlie Zhu. Now let's get straight to the Bloomberg Business Flash with Leanne Gerrans. Hi, Leanne.
Hi, Francine. DW's group says CEO Asoka Verman has resigned and will be replaced by the head of Deutsche Bank's corporate bank, Stefan Hoops. Verman's resignation comes just hours after Frankfurt police raided the headquarters of Deutsche Bank and DWS, which is the lender's asset management unit. Prosecutors say the search was related to allegations that DWS was inflating its ESG credentials. DWS says it is cooperating fully with authorities. Now, Singapore Airlines says it is committing to a strategy of working with international partners and operating overseas hubs after COVID exposed the financial dangers of not having a domestic aviation market. The CEO, Goh Chun Pong, told us exclusively that the airline is open to opportunities and will elevate potential synergies.
From day one, Singapore Airlines do not have a domestic market, and we compete internationally with the best out there throughout these 75 years. What happened is that we became extremely good at international competition in terms of our product leadership, service excellence, and our network connectivity.
And finally, Bloomberg has learned that HSBC is offering its UK staff the chance to lease electric vehicles using their pre-tax paychecks. Sources say all of its 3,500 employees in the country are eligible for the perk. They can choose between a 2- and 4-year lease and may buy the car from HSBC at the end of the contract. And that's your Bloomberg Business Flash. Francine.
Leanne, thanks so much. Leanne Gerrans there. A lot of people in the newsroom would love a Tesla. Now, Russia has long acted as a global commodity supermarket. Today's Big Take says that even with some countries now halting energy purchases, Russia's oil and gas revenue will be about $285 billion this year. Now, meanwhile, the rally in oil prices fizzled after a report that OPEC members are exploring the idea of exempting Russia from its production deal. Grain futures also plummeting as prospects for food exports from Ukraine improve. Well, joining us now for more is Bloomberg's oil strategist, Julian Lee. Julian, great job, of course, on this Big Take. We have this Big Take story about how Russia continues to make billions off commodities. Is that something that sanctions could actually change or no?
I think sanctions can have an impact, and I had a very small part to play in that story. Sanctions can have an impact. They're not going to send Russia's earnings to zero, and nobody should expect them to do that. But they are going to have an impact, and the self-sanctioning that has been going on has already been having an impact. Russia is getting a lot less for every barrel of oil that it sells than it was even at the beginning of the year. It's certainly getting a lot less than the sort of headline Brent prices that we see would suggest. Its own figures show that it's in between sort of mid-April and mid-May, the discounts that it was having to offer were close to $35 a barrel on average. So sanctions and self-sanctioning has had an impact. The moves that the EU has just passed will have a bigger impact, but they won't reduce it to zero or anything close.
So, Julian, how do China and India actually play in this picture of funding Putin's war?
Well, one of the things that we have seen is a big shift in the movement of crude oil that comes out of Russia's western export terminals. These are ports on the Baltic Sea, the Black Sea, and in the Arctic. Traditionally, those have stayed very local. The Baltic and Arctic shipments have largely gone to Northwest Europe. The Black Sea shipments have either stayed within the Black Sea or gone to refineries in the Mediterranean. We're seeing many, many more barrels moving from those ports now, particularly to India. In the east, we're seeing China taking barrels that previously went to Japan or South Korea and the United States. So we are seeing those movements, but they're much, much more expensive to do because the journeys are much longer.
Yeah, more expensive journey. And then, of course, if it comes to gas, it's almost impossible to transport it by cargo. Julian, also, what moves will we expect, or do you expect, from OPEC Plus and that meeting later on? What does it mean if they exempt Russia from their production deals?
Well, I think that at this meeting tomorrow, we're probably going to get another straightforward rollover of the deal as it stands. That's another 435,000 barrels a day on paper to production. The actual production isn't rising anywhere near as quickly as that. I'm a little bit skeptical about this talk of exempting Russia from its output target. I don't see it having any big impact. Russia's production isn't limited now by its OPEC Plus target. It's limited by the impact of sanctions, both on exports and on oil-filled equipment. So I don't think it has any impact on Russia's production if it happens. There's been talk that Russia's share may then be divided up among other OPEC Plus countries. But Saudi Arabia has been very much against that kind of a process, even for the smaller countries that couldn't meet their targets up until now. I think doing that would damage relations between Russia and the OPEC countries, and I think those relations are important to both. And then I think there are questions that even if Russia's target is shared out, who has the spare capacity to pump those barrels? And I'm not sure that there is a significant amount of spare capacity. You know, if you look at Saudi Arabia, they are pumping now almost as much as they have pumped at any time in the past outside of the production free-for-all in 2020.
Julian, thanks so much. As always, Julian Lee, there are Bloomberg oil strategists, and I urge everyone also to go online on social media or on the Bloomberg terminal to check out our big take. Coming up, as inflation soars across much of the world, politicians, of course, are grappling with growing public anger. We have more on the political fallout from rising prices. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, this is what the markets are looking at. Stocks in Europe, U.S. equity futures struggling for direction. Big debate still every day, day in, day out, over the scale of central bank monetary policy and the tightening needed to fight for inflation. This is a picture across the board. European bonds falling, treasuries extending a decline. And if you look at the 10-year yield, 2.8640. Now, a rare meeting between Biden and Powell. The U.S. president says he respects the central bank's independence, but at the same time is attempting to shift responsibility for taming inflation ahead of this year's midterm elections.
My plan is to address inflation. It starts with a simple proposition. Respect the Fed. Respect the Fed's independence.
Well, for more, we're joined by Bloomberg senior reporter for international affairs, Mark Champion. Mark, always great to speak to you. We were in Davos last week, and of course, all of the panels and debates on energy transition, on inflation, went back to the fact that politicians worried about the citizens of this world. With inflation above 8%, what can they do?
Yeah, I mean, there's, to an extent, there's a trade-off here, which is a tough one. So on the one hand, if you want to really constrain Russian revenues, you need to cut back on imports of oil from Russia. You should cut back on imports of natural gas. As soon as you do that, price goes up. And energy prices go up in your countries. And actually, the pattern so far is that Putin has received more revenue from oil and gas because the price went up. So it's a tough one. And for politicians, the real calculation is that in terms of domestic politics, people care a lot more about their food and about prices than they do about Russia.
What are we looking at in terms of the political implications? So I know we were talking about Emmanuel Macron and, of course, Marine Le Pen, how that was decided also on the cost of living. But are governments going to be toppled on the back of this?
Well, some may, and you know, you've already seen protests in Peru, for example, over precisely this issue. In the Middle East, places like Egypt, which are really very dependent on grain from Ukraine and Russia, seeing prices go up, availability fall. Remember also that the Arab Spring was sparked largely about food prices at the time. As soon as you throw this kind of real shock, price shock into the equation, then it's hard to predict exactly where or what the political fallout will be, but there will be fallout. Yeah,
and this is, I imagine, in especially parts and countries where they're most dependent on the price of wheat and grain.
Absolutely, and you know, you've got more than 50 countries where who get more than 30% of their grains from Russia and Ukraine. So that's very significant.
And this is not really about inequality. I mean, it's inequality in certain countries, but there's something much deeper. If people can't eat, then it's unclear how these populations will also shift.
Absolutely. I mean, this is visceral. Food prices are visceral, and politicians know this very well.
Mark, as always, thank you so much for great reporting and, of course, bringing us this very important story, our Mark champion. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Kailey Leinz will be in New York, and Edwards here in London. They'll spend a good amount of time, of course, looking at the markets. If you look at the Euro Stoxx 600, they surrendered some of the gains that we saw in the earlier part of the trading day. Investors assessing cheaper valuations against a record jump in Eurozone consumer prices. And then if you look at some of the individual moves, Dr. Martens, they surged after a pre-tax profit actually beat estimates. Some of the other things we need to watch out for is, of course, the future of OPEC Plus and unity there as ministers from the group prepare to meet tomorrow. This is Bloomberg.
We're in an environment now which is very different to the one we've seen in the last couple of decades.
This inflation's really coming from everywhere.
I think it's too early to call the peak level of inflation. I know the market is very anxious to call peak prices.
We've got to get back to the table and sit there and almost make a war plan. How do we want to address energy problems? How do we want to address food problems?
The Biden administration has a very real problem here. They've got to get inflation down to a more comfortable 3%.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Wednesday, June 1st. Our top stories today. A surprise admission from Janet Yellen. The U.S. Treasury Secretary says she got it wrong on inflation and blames unexpected shocks to the economy and supply bottlenecks. The price of oil is rising. Investors are assessing a report that OPEC members may suspend Russia from its production deal. And a shake-up at Deutsche Bank's asset manager. The CEO of DWS Group resigned hours after a police raid over so-called greenwashing. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz over in New York. Kailey, good morning. And a lot of political talk, a lot of political conversation around inflation. Janet Yellen saying that she thinks she got it wrong. Well, let's face it, she'd be in good company because so did many people.
Yeah, I think a lot of us got inflation wrong, Anna. And of course, that is something that this market has to continue to weigh in this month of June, just as it did in May, which saw the equity markets really going absolutely nowhere at all. As for how June started in Asia overnight, it was pretty mixed overall. You had stocks down in China and Hong Kong. That dragged the MSCI Asia Pacific Index just fractionally lower, only down about 0.2%. But your outperformance in Asia came from Japan. The Nikkei 225 actually rising by about 0.7% or so. And that was in large part due to the weakness, once again, of the Japanese yen. The yen weaker against the U.S. dollar for a third day in a row. It is getting closer to that 130 handle once again. It continues to be a rate differential story. You have policy on the Bank of Japan staying easy while the Federal Reserve is consistently hawkish. That obviously has pushed Treasury yields higher over the last couple of days and as a result putting pressure on the Japanese currency. And of course, it's not just Treasury yields that have been moving higher, Matt. It's really a story across the world, including in Australia, where their 10-year yield was up 7 basis points again for a third day in a row overnight. It's now trading right around the 342 level, Matt.
All right, so we do see yields rising around the world and really a struggle for direction in terms of stocks that are trading cash right now. In terms of futures, we're up right now on the S&P futures, but only by 0.1%. So still waiting for some catalyst to move us today. Not the case with Treasuries. The second day in a row that we see yields rise as investors sell off that debt. Of course, Chris Waller on Monday made headlines in Frankfurt saying he thinks the Fed needs to do 50 basis point hikes at every meeting until inflation gets closer to the Fed's 2% target. And of course, we're still very far away. Janet Yellen yesterday talking about the core at 6. NYMEX crude right now up 1.5%. One of the big drivers has obviously been energy prices of inflation. But 116.22, it's actually a smaller barrel price than we saw yesterday. For much of the day, we're trading at 117. And Bitcoin right now down 0.5%, but still up over 31,000. Remember, this measures the change in price since midnight. And yesterday at this time, we were looking at 31,600 as well. So still stuck at that level, just a little bit higher than we had been over the past few weeks. Anna, what do you see in Europe?
Yeah, struggling for direction here then, Matt. You mentioned it. You said that we were struggling for direction in cash markets, and that seems to be what we're experiencing here in European equities. The end of May, or towards the end of May, last week, certainly ending in decent form, appetite for risk assets, but not sure whether that has more to go here this week or whether we take a leg down further from here. And that seems to have caught us in sort of limbo here. UK market is down by 0.2%. The German market, the French market up by 0.3% this morning. And really, it's the sector weighting that are driving that. Let's have a look at where we are on one of those sectors. This is what weighs on London today, down by 1.6% on basic resource stocks on the mining sector. Sticking with commodities, this is Brent crude. This is the August price versus the close of the August price yesterday. So looking at that particular contract for you, 1.4% higher. So just in keeping with what Matt was saying there about the higher energy prices, the higher Brent crude price. Zalando is in focus, the German online fashion retailer, down by 4.8%. A couple of brokers downgrading their guidance or their estimates when it comes to Zalando, and so that's weighing on the stock. And I put in Dr. Martens, the maker of iconic boots, Kailey. The stock is up by 28% today. They've guided higher. They've said they've got pricing power. They can pass on higher costs to consumers. I don't think it has anything to do with the fact the Sex Pistols song, God Save the Queen, they are big wearers, of course, of Dr. Martens, is vying for the #1 chart position as we head towards the long
I think you're dating yourself.
Weekend.
I'm not sure Kailey knows who the Sex
I am
Pistols
dating myself.
Were.
I'm not sure she does, but she
I'm
knows
shocked
what
that
Doc
the kids
Martens
are wearing Doc Martens again, right? I mean, I threw out my last pair 25, 30 years ago, and now they're back.
Vintage.
Yeah.
Everything comes back around, just like bell-bottom pants. Skinny jeans are out, if you haven't heard.
Thanks,
all right, now let's take a look at what else is ahead today, other than some fashion commentary here on Early Edition. There is a lot going on, including ECB Governing Council member Klaus Knott speaking at the Bank of International Settlements Green Swan Conference. PBOC Governor Yi Gang, ECB President Christine Lagarde, and other central bankers also will be speaking. Plus, GameStop reports its earnings results at 4 p.m. New York time. And then finally, on the front of the Federal Reserve, it is set to finally start shrinking its almost $9 trillion balance sheet later on today. Plus, the central bank's beige book is released at 2 p.m. New York time, Matt.
All right, so we will watch out for that data. But let's talk about President Biden. A number of news items coming out of the White House yesterday. He used a fairly rare meeting with Fed Chair Jerome Powell to highlight the central bank's independence and kind of pass the buck to them in terms of responsibility for inflation.
My plan is to address inflation. It starts with a simple proposition. Respect the Fed. Respect the Fed's independence. They have a laser focus on addressing inflation, just like I am. And with a larger complement of board members now confirmed, I know we'll use those tools in monetary policy to address the rising prices for the American people.
Treasury Secretary Janet Yellen was also in attendance. She admitted she underestimated inflation risks last year. A little late, but I guess it's still worth something. And in an interview with CNN, she said, quote, "I was wrong about the path inflation would take. There have been unanticipated and large shocks to the economy." Bloomberg's Washington correspondent Anne-Marie Horder joining us now from Washington, D.C. So, Anne-Marie, what do we make of the president's meetings yesterday?
Well, I guess who you ask, but one thing is certain, Matt, and that's that the president wanted to make clear, and then his deputies out on a lot of cable networks, Brian Deese in the briefing room, really wanted to stress this point that the president respects the Fed and wants it to be an independent Fed. So in that sense, as you say, he's almost passing the buck over to Fed Chair Jay Powell. This is in the Fed's realm to deal with inflation. And that the president is saying, first and foremost, it is their job. The administration is also talking about a number of other measures. We've seen them talk about, of course, over the past year, really. They're just now tainting it or putting in a little bit of a tainted frame when it comes to inflation, talking about how they can get costs down for American families, whether or not that's tax incentives for climate initiatives to maybe reduce energy off of fossil fuels or bringing down prescription drugs. But you're going to see a concerted effort from this White House and the administration over the month of June to talk about the economy. One, the robust recovery, but then also how they are dealing with inflation. Because this is something that is really battering Biden in the polls, is on top of mind of everyday Americans.
I guess he was saying, though, yesterday, he's saying, I'm going to deal with inflation by letting the Fed deal with it. And he also kind of said there's not much we can do about guns. It seems like a lot of these messages out of the Oval Office are, we can't really do very much.
Well, it depends what the issue is. And when it comes to inflation, I think what the president wanted to do yesterday is just remind the public, which doesn't really talk about the Fed the way we would say on Bloomberg or Bloomberg terminal users, the same way that everyday people going to the grocery store, going to fill up their tank at the gasoline station understand, like, really whose responsibility is it to tame consumer prices. So that's what they wanted to do. But at the same time, obviously, if you're an individual in America, you're not going to blame Jay Powell, right? You're going to blame the individual sitting behind the Resolute desk in the Oval Office. And that is why they are going to make an effort to talk about any ways they can tackle inflation. But it's very difficult for this White House to tackle inflation, especially when they're dealing with this energy crisis.
Yes, and dealing with a lot abroad, and these are linked, of course, the domestic and the international agenda, Anne-Marie. Also talk then over the past 24 hours of advanced rocket systems that the US says it will now supply to Ukraine. What difference will they make?
Yeah, this is the second opinion piece also we should note the president has penned over the last 24, 48 hours. So first was on inflation. Now he's talking about the war in Ukraine. And these are new systems, Anna, and the missiles could reach about 80 kilometers. That's like 40 or 50 miles away. There was a lot of discussion about which kind or how long of the range of missiles they should be sending over, because the worry would be that could Ukraine then hit Russia? Potentially, does that bring any NATO members into this conflict? The U.S. says they have assurances from Ukrainian government that they would not be using it to target Russian land, but they are sending these missiles. And the president, writing in the New York Times, said what they want is an end to this conflict. That means a negotiation at a table. That means a peace deal. But negotiations are always reflected on what's going on the battlefield, and they felt it was necessary to send these types of missiles. We're going to have more details on that today. It's another tranche of assistance, about $700 billion worth.
All right, Bloomberg's Anne-Marie Hordern in Washington for us. Thank you so much.
Million dollars, excuse me.
Important correction, Anne-Marie, thank you. On the subject of Russia, investors are also weighing the future of OPEC Plus and that alliance that Russia is, of course, for now a part of, just as ministers from the group prepare for their routine meeting on Thursday. According to the Wall Street Journal, OPEC Plus members are exploring the idea of suspending Russia from its oil production deal. Let's get more on the upcoming meeting with Paul Wallace, who leads our Middle East energy and commodities coverage. So, Paul, how big of a blow would it be to Russia and Vladimir Putin himself if Saudi Arabia and the other members did cut them out and increase production faster?
I think that would be a very big blow for Russia and for Vladimir Putin personally, if there was some kind of breakup at OPEC Plus, or there was a change in the agreement that allowed Saudi Arabia, the UAE, and perhaps some other Gulf OPEC members to increase production. Russia has consistently said that OPEC Plus must stay together, that it's a force for good in oil markets. And that's something that the Saudis and the Emiratis and other OPEC members have also been saying. So if that changed and let's say Saudi Arabia did increase production significantly, that would in essence be Saudi Arabia ditching Russia and moving even further into the US and the Western camp, and that's certainly not something that Putin or the Russian government would want.
Paul, thanks so much. Paul Wallace there from Bloomberg News talking to us about the possibility of OPEC Plus becoming just simply OPEC again. Now let's get to Germany. Deutsche Bank has replaced the CEO of its DWS group. This just hours after the police raided the asset manager amid allegations of greenwashing. Let's get more with Stephen Ahrens, Bloomberg banking reporter in Frankfurt. So, Stephen, why did the CEO step down? What are these greenwashing allegations, and who's going to replace him?
So, hey, Matt, the CEO, the former CEO now, I guess, Ahsoka Verman, decided to resign after this raid. There were police officers and law enforcement officials entering the building over evidence that DWS has overstated publicly just how much of sustainability factors they're putting into their investment decisions, which would be misleading investors. These allegations have been swirling for months, almost a year now, and they've always been a cloud over his head. He now had to draw a line. Deutsche Bank was pressuring him, and the new guy now, Stefan Hobbs, is a close confidant of Deutsche Bank CEO Christian Sewing. He's been running the what's called the corporate bank in the business. He's actually a trained trader, and he's now going to have to run the asset manager.
Okay, so new leadership at the asset manager, and of course DWS is the asset management arm of Deutsche Bank, Stephen. So what does this mean for the parent company?
It means they have now another big legal cloud over their heads, right? I mean, prosecutors raiding a unit is definitely something that they can't use at this moment. Deutsche Bank is in the throes of a turnaround. They've been restructuring the bank for years now. They're now on a way to achieve a really good profit this year. And this is something that now casts a shadow over that track record of Deutsche Bank CEO Sewing himself, because he was the guy who appointed Verman back in 2018. It's something you can't need at this moment.
All right, Bloomberg's Steve Ahrens, thank you so much. Now let's get back to the U.S. and take a look at some stocks moving in pre-market trading here that we're following. One big mover to the upside is Salesforce. It actually reported after the bell yesterday, raised its profit forecast, showing that demand remains pretty strong for the business software. That stock is up about 8.4% in early hours as a result. Another stock that is moving higher is AMC. It's riding the high of Top Gun Maverick, which did incredibly well in its opening Memorial Day weekend here in the U.S., actually a record Memorial Day for any movie. So AMC is benefiting from the phenomenon of Tom Cruise and those jets, up nearly 2% in early hours. One stock that is moving lower, though, that we should keep an eye on today is ChargePoint. This operates an EV charging network. It posted a wider first quarter loss than expected. Also, gross margins contracted, that together taking the stock down about 3.8% before the bell, Anna.
Lots to watch then at the start of trade. Coming up on this program, Skylar Montgomery Koning, TS Lombard Senior Global Macro Strategist. We will talk to her about everything influencing markets right now. What does she make of quantitative tightening? What's the big risk point for markets as the Fed embraces that from today? Christian Horner also joins us, Red Bull Racing CEO. That team riding high in the driver championship right now, the driver standings. We will talk to him about his expectations and how well the Formula One phenomenon is now doing in America, plus how the world is paying for Putin's war. Russia will make more this year from selling oil, gas and other commodities than it has seen frozen by international sanctions. Read more by typing NI Big Take into your terminal. This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. We are simulcast on both Bloomberg Radio and Bloomberg Television. I'm Matt Miller here in New York with Kailey Leinz, Anna Edwards with us out of London. Now we're watching a continued rise in the price of oil as we all worry about the inflation that it's causing. But we may have seen a peak, at least according to two-year break-evens. I've got here a chart of U.S. and German two-year break-evens, which have rolled over in the past couple of months, coming down from their peaks. Now, oil continues to rise, but if you look at the charts going back, it's been lagging the break-evens. So maybe it's time for oil to peak as well. Noor Al-Ali joins us, Bloomberg Markets Live editor out of London. London. So, Nora, what do we think? Is this it? Have we reached the apex?
I think that's a very valid question. A lot of my colleagues will tell you, though, it's absolutely crazy to be an oil bear at this time because there's so much that's going on for oil at the moment. However, if you do factor in the latest news from Wall Street Journal that perhaps Russia could be kept out of the OPEC supply agreement and we might see more oil coming out of Saudi, that for me signals perhaps a question of whether or not supply could be upped from the Russian side to Asian consumers, which are big buyers in the market. So it's all about demand right now and whether or not it would pick up against the backdrop of prospects of slowed economic growth out of China, which is a big deal, obviously, for commodities.
Yeah, no, our colleague, Mark Cudmore on the Markets Live blog talking about how, all of the supply issues are priced in. It is all about demand. I know he was making that point earlier on. Talk to me about where we are on the Fed and the ECB then. This week has really been dominated by higher inflation once again coming through from the Eurozone, and Europe really in the driving seat when it comes to the yield story, the sovereign debt story.
Yeah, absolutely. And it's a reflection of how the market assumes or thinks that the ECB is lagging the Fed and even the BOE in their inflation pricing and their rate hikes. ECB's Holzman, which is a big hawk, of course, said that perhaps, those hot inflation prints bring into question whether or not 50 basis points is possible for July. That'd be fantastic from, a fixed income market perspective. I do think that's perhaps a bit harder to think that all of the ECB members would say, yes, absolutely, let's go with the 50 basis points. I think we're going to be a bit more dovish on that side.
Okay, yeah, hawks like to be hawkish, obviously, so we'll bear that in mind. But Nora, thank you very much, Nora Lally of Bloomberg Markets Live. And for more market analysis, check out MLIV Go. That is the function to use on your Bloomberg terminal to keep up with the Markets Live blog. This is Bloomberg.
Welcome back to Bloomberg Surveillance Early Edition. Now keeping you up to date with news from around the world, here's the first word. China is planning for years of COVID-0 with testing sites on almost every corner. Tens of thousands of lab testing booths are being set up across the country's largest and most economically vital cities. The goal is for residents to always be just a 15-minute walk away from a swabbing point. The U.S. Supreme Court has blocked a Texas law that targeted social media platforms. Critics say the measure would require Twitter and Facebook to allow hate speech and extremism. The High Court put the law on hold while social media firms challenge it in the lower court. Texas Republicans say the law is needed to protect conservative voices from being silenced. And of course, Elon Musk has made quite an issue of free speech on Twitter as of recent weeks. And we also heard him on Twitter overnight, Matt, talking about the return to work. Apparently, he wants Tesla employees back in the office at least 40 hours a week.
Yeah, he has apparently reportedly sent a very angry letter to employees saying they have to get in, and tweeted that if they don't want to work from the office, they should pretend to work somewhere else. Now, I don't want to sound too woke, Anna, but it seems to me study after study shows that people working from home are doing more than they did in the office, and yet all of these middle-aged white male bosses are angry about it.
Even we managed it for a period, Matt, which must say something. Yeah, it's difficult when these things become caught up in culture wars. They tend to become a little too binary and lose some of the granularity. We'll get back to the markets shortly. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. A surprise admission from Janet Yellen. The U.S. Treasury Secretary says she got it wrong on inflation and blames unexpected shocks to the economy and supply bottlenecks. Last year, Yellen predicted that elevated inflation wouldn't pose a continuing problem. The price of oil's rising. Investors are assessing a report that OPEC Plus members may suspend Russia from its production deal. That could mean an end to the OPEC Plus supply pact and see Saudi Arabia add more barrels earlier than expected. And a shake-up at Deutsche Bank's asset manager, the CEO of DWS Group, resigned hours after a police raid over so-called greenwashing. There are allegations that DWS made unsupported claims about ESG investments. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Matt, really searching for direction, it seems, on European markets and maybe on US futures right now.
That's right. Although we are looking at gains, they're only up about 0.25% right now. And we do have investors selling bonds, again, pushing those yields higher. So right now you can see S&P futures actually not even a quarter, up 0.2%. Maybe this is what a relief rally looks like. We had a little bit of a drop in the cash trade yesterday. The 10-year yield continues to rise. That should be no surprise, I guess, as you have Fed speakers coming out saying we need to continue doing 50 basis point increases. Obviously, if the paper is going to yield more later, why would you want to hold this paper? And then NYMEX crude, right now at 116.49. It's up 1.5%. Now, this is going to look a little bit confusing. If you saw us yesterday, we were at 117. We almost hit 120 on NYMEX yesterday, up about 5%, but then came down drastically into the close. So this is a little bit of strength coming back into crude as we start to focus more on OPEC non-plus. And then Bitcoin right now down about 0.5%, but still at 31,646. So a similar move in Bitcoin yesterday. You saw it at this level, even stronger yesterday at this time. It came down into midnight, and now it's at 36,646. Again, Kailey, what do you see in terms of the pre-market movers?
Well, I'm focused on that oil story as well, Matt, because as you're seeing oil prices moving higher, it's giving a lift really broadly to energy names here in early hours in the U.S. That includes the likes of Marathon Oil up about 1.75%, and big majors like Exxon also are moving higher. It's up about 1.3% or so. Another big upside mover is Salesforce. It actually reported earnings after the bell yesterday and gave a really optimistic outlook, raising its earnings forecast. Shows that demand for some of that business software is still strong, even in the face of all this macroeconomic uncertainty that is out there. Salesforce is up a little more than 8% as a result. One stock moving lower, though, keep an eye on it, is GameStop. Of course, this is the original meme stock. It was part of a broad sell-off in meme stocks yesterday. It actually fell about 9%, giving back some of the gains it saw in a really strong week last week. It also will be reporting earnings after the bell today, Anna, so it'll be interesting to get a read on the actual fundamentals for this company that often has traded just completely not in line with those fundamentals, Anna.
Yeah, meme stocks, old school. Kailey, let's have a look at European equity markets then. And we really are searching for direction here. Matt was saying slight gains coming through in US futures. Well, here, European stocks down by 0.1%. The basic resource sector still weighing, getting some gains in banking and in autos. But we're quite divided here in terms of where we are on European equity markets. Brent crude up by another 1.6% today, 117 the handle. This is the August contract compared to the closing price of the August contract yesterday. Zalando down by 2.8%. This is an online clothing retailer over in Germany. A couple of brokers downgrading their expectations for this business, and so as a result, that one is suffering today. Dr. Martens, though, out with an update. The maker of the iconic boots, the company saying that it does have pricing power. It's guiding higher and saying it can put up its prices, so we see that stock jumping by more than 26% this morning, Kailey.
Yeah, some really interesting micro stories that are out there, Anna, but let's get back to the macro picture now. Joining us is Skylar Montgomery Koning, Senior Macro Strategist at TS Lombard. Skylar, it's a new month. Happy June. How optimistic or pessimistic are you feeling in this June compared to May?
Yeah, I mean, so when we've done our asset allocation stance, for the first time since 2020, last month, we downgraded our stance to below 1. So that is our beta to our benchmark is below 1. So it represents a significant de-risking. And specifically in the last month, we've gone from being a small overweight in developed market equities to a small underweight. Since 2020, we've also maintained an underweight in government bonds, and we've moved that allocation up a bit this month. And so because we've reduced our overweight in equities, we've been pushed into cash, and I think a lot of the market has as well. And that cash allocation for now, for us stands at 10%, which is kind of the max of what you can reasonably expect. And the reasoning behind these changes is, the global economy is moving towards a slowdown. That's where economic conditions are worse than average, and they're getting worse still. And of course, there are differences between countries, but importantly for allocators, the slowdown, part of the cycle is the worst part of the cycle for risk assets. And not only is that negative, but we're also getting countercyclical inflation. As we've mentioned this morning, or you've mentioned this morning, you've got that oil price spike that's also feeding you negatively.
Skylar, that all sounds pretty negative then and pushed into cash. And we haven't even seen quantitative tightening start yet. It starts from today from the Fed, although it has been happening from other central banks around the world already. What are the biggest pain points for markets, do you think, from QT, from quantitative tightening?
Yeah, I mean, I think what's underappreciated is the fact that yields can still go up. And so, we're still underweight government bonds, and that reduction, we've reduced. But I think, markets, they're looking for places to hide, right? And quantitative tightening combined with the fact that you've got this countercyclical inflation now occurring in the U.S. means that there's a very high risk that, people are moving to being worried more about growth than inflation, but inflation is still a worry. And so, there's a very high risk that you still get that positive equity bond correlation. There's not anywhere to hide. And so I think investors have shifted more into government bonds because that yield is higher, but I don't think that's necessarily a safe place to be. And so you have to look for alternatives.
How long is inflation going to be a worry? I mean, aren't we supposed to start feeling the base effects soon? Shouldn't these numbers be coming down drastically?
Yeah, I mean, I agree, right? So, we've been positioned for falling break-evens for about a month or so now. But, break-evens and inflation is still very, very elevated. We do think inflation will settle higher this cycle, especially in the U.S. So in the U.S., we see inflation kind of around 2.5% to 3%. Mathematically, longer term, as you say, inflation will have to fall on base effects alone. The rapid rise in commodity prices, it's a shock, but it's a shock. So for that to feed continuously into inflation, you need commodity prices to continuously rise to that degree. That will feed up eventually, as well as China lockdowns, while it will continue. They're getting better at managing that. So, that will come down, but the problem is, will it come down fast enough? And so the expectation for U.S. inflation is that we're still, even the Fed thinks we're still going to be up at 4% by the end of this year. And they've now admitted that in 2023, they're not going to get back to their inflation target. And so, the 2023 forecast for the Fed is 2.5%. And so while it's still coming down, we need it to come down in a clear and convincing way, the Fed has said, for them to back off policy. And we're not going to see that this year. And the risk is very likely that we're not going to see that as we head into 2023.
So how much more room upwards for yields to move is there then, Skylar?
So, in terms of when we're looking at policy rates, for us specifically, we have a model that we input, Fed dots into kind of the forward curve, and we look at it over the next 10 years, what policy expectations are. And if you put the Fed dots in, which are lower than what the market expects, in the near term, you get to a 10-year yield that's justified of around 3%. Now, the problem is, I think we're going to have to overshoot that. And so our chief U.S. economist, Steve Blitz, thinks that inflation will be persistent enough this year and growth okay enough in the U.S. that, you'll see the Fed hike aggressively into next year. And you may even get our base case, or the highest probability for us is that you get to above 4.5% in the Fed funds rate by mid-2023. And that justifies then a higher than 3% rate. We're seeing a big divergence in terms of our expectations for real yields versus break-evens. And so we think break-evens will come down, but that real yield will continue to rise. And you could see significant pressure there. And so I wouldn't be surprised if we get above 3% on the 10-year.
And Skylar, you mentioned about getting into cash, and you thought a lot of people in the market have been pushed into cash. What does it take to get that cash off the sidelines then?
I think the problem is positioning and sentiment. People are looking for that moment, right? So we've seen this rally, and it's a 6% rally, and there's been lots of talk about bear market rallies and that kind of thing, in terms of that's what we're seeing now. But if you look at previous bear markets, if you look at 2008, for example, the largest rally that you saw, during the whole bear market, you were down around 60%, but you saw a rally of 24% during that period, and so. The scale that we're seeing now is quite small, and I don't think it represents a turnaround in sentiment because the economic conditions are worsening so much. And I think, that's a staple of the bear market, right? Is that positioning and sentiment are very, very low. People aren't looking to get back in. And so I think, you need a significant turnaround in the economic conditions, or you need the Fed to come off the break, or other central banks to come off the break for people to get back in. And that doesn't seem to be happening, or we don't think it will happen in 2022. And so you'll continue to see these rallies, but the downtrend is still there in equities especially.
Skylar, thanks so much. Thanks for joining us. Skylar Montgomery Koning of TS Lombard with her thoughts on the markets. Coming up on this program, we will talk Formula One. We will talk racing with Christian Horner, Red Bull Racing's CEO. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, EU Commission Executive Vice President and Trade Commissioner Valdis Dombrovskis. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz in New York and Anna Edwards in London. Now, last month, Formula One made a big push, an even bigger push, into the U.S. with the inaugural Miami Grand Prix. The U.S. has historically spurned the racing series in favor of NASCAR as well as other American sports. But now it's front and center after a Netflix documentary has fascinated Americans from coast to coast. Joining us now to talk about the future of what is, I think, otherwise the most watched league in the world is Christian Horner, CEO of Red Bull Racing. Christian, thanks so much for joining us. To what do you attribute this burgeoning popularity in America of what had previously just been a global obsession?
Well, I think that, the great thing is, Formula One through the Netflix, series, this Drive to Survive series, it's engaged, America, and, the sport's always been great, but I think now it's been a great way of introducing people to the sport, explaining the sport, and getting to know some of the personalities, some of the challenges, that go on in the business world as well behind the scenes.
What about the racing? You have had incredible success at Red Bull. You've been doing this there for, I think, 15, 16 years. But I've heard you lament the loss of the V10 and V12 engines. Now that we get into these, tiny little, I think, 1.6-liter hybrids, it seems like the racing has improved.
Yeah, look, the racing's been fantastic. And I have to say, since Formula One was bought by the Liberty Media Group, the regulations that have been introduced to promote better racing have been, they're working. And we're seeing some great racing, some, the best drivers in the world going wheel to wheel at some of the most exciting circuits. And it's a fantastic competition. So it seems to be working.
You won, of course, last year with Max Verstappen, the entire championship, and he's leading this year. Your other pilot, Checo Perez, has won probably the most iconic race in Formula One at Monaco. What do you think about your chances this year?
Well, look, I think we've got a chance. There's been the biggest regulation change this year for 40 years. The team's done a great job in adapting to those regulations, and having achieved that world championship last year with Max, we're determined to defend it. And in Checo, we've got a driver that's growing in confidence. He's just won the Monaco Grand Prix 2 days ago. I think he's still recovering from that. But, we've got these two wonderful drivers that, we're taking on new challenges from Ferrari this year.
Good morning to you, Christian. I wonder how you manage the rivalry within the team between these two great drivers. When you've got one in first position on the drivers driver standings, and you've got one in third. I mean, how much of a challenge is that?
It's a nice challenge to have, but ultimately they're team players. They're part of the team. It's not Sergio Perez racing or Max Verstappen racing. It's Red Bull racing, and they work for the team. They have a responsibility. They drive the cars that the 800 or so employees here have designed and produced for them. So, they're one link in the chain. They're a very important link, but it's vital that they recognize that, the team's ambition is greater than their own.
Let's talk about competition in a different way in the form of M&A in the F1 space. Christian, would you consider an offer from someone like Porsche or Audi?
Well, look, I think it's fantastic that they're talking about coming into Formula One. It's iconic brands, particularly the Porsche brand, is particularly iconic. And of course, we're heading into a new chapter as we become power unit manufacturers. So other than Ferrari, we'll be the only team to have engine and chassis under one roof. So, it would be logical to hold conversations with them, after declaring their intent to enter the sport.
Yeah, is there room for other teams, for new teams on the grid? Is there always room, Christian?
I think we've got a 10-team system at the moment, and that works very well. So effectively, you've got 10 franchises involved in the sport, and I think you dilute that by introducing more teams into the sport. So I think until 2026, I can't see any new entrants coming in it'll be a case of having to take on one of the existing franchises if a new party were to want to come into the sport.
One of the great things that Porsche and Audi have is a ton of money, right? It's so expensive. You've even said that you're not sure all of the teams right now can compete because of the cost. They're prohibitive. Is that a problem?
But it's more the cost cap rather than the actual cost. I mean, the sport is in great health. I mean, we've got some fantastic partners. We've introduced a lot of American partners. So, Oracle have become our title partner this year. We have companies like ExxonMobil, a whole plethora of different companies that are supporting the team. But with a cost cap, it's the amount of money that we're restricted to spending, which is the challenge. But that is creating a more equal playing field for the 10 teams.
What do you think about trying to manage the popularity at the same time as staying true to your heritage, right? There have been a lot of complaints that the track in Miami was not up to snuff in terms of quality, and there's a lot of talk about Monaco actually falling out of the schedule.
I think it's always a matter of finding that balance, and each circuit has different characteristics. And Monaco is part of the DNA of Formula One. It's been there since the beginning. It's a little bit like Wimbledon is to tennis. And the Miami track, it produced a great race. It's probably not the most challenging of circuits for the drivers, but it's a 22 race championship, and it's a matter of being competitive across all of these different circuits, street circuits, permanent circuits, some of the iconic historic circuits as well. And that's part of the challenge of Formula One.
Christian, thanks so much. Thanks for joining us here on Bloomberg TV. Christian Horner, the CEO of Red Bull Racing. Coming up throughout the month of June, our new special Bloomberg Equality takes a look at what equality means for the economy, for companies and for investors. Catch it every Thursday at 1 p.m. New York time. That's 6 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Also joining us, Tom Keene, co-anchor of Bloomberg Surveillance, who's with us now. And I know you have a single best chart, Tom, that reflects on the fact that here in the UK, I mean, it was a ghost town coming into work, frankly, this morning. A lot of people away, I think. Jubilee holidays approaching.
Well, it's going to be interesting, Anna. And, of course, I know, Anna, you're going on a special extended bank holiday weekend, is what they're calling it, for the Platinum Jubilee. Let's look at the state of the United Kingdom. Back to 1956. This is a really interesting story. I did not expect this chart. This is log per capita GDP, and the answer is slope matters, and there is a beautiful slope until the bank crisis of 2007, 2008. Things change. Yes, a little bit of a pandemic over by where we are now. But this is what has been given up in 15 years of economic growth, Anna, in your Britain. It's very French-like, it's very Italian-like, and I really didn't expect it, but there it is. It is a changed United Kingdom.
Tom, I'm excited about the program today. I was just looking over NLRT on my terminal, shows me all the alerts that I have. And the only people I have set up here are Matt Levine, Gary Schilling, Mohammed El-Arian, and Howard Marks. You've got Howard Marks on the program today.
We're going to have Howard Marks, Lisa Abramowitz, in an extended conversation with Mr. Marks and State of the Market on what value means today. Speaking of value, we'll get value from William Dudley, Bill Dudley, the former president of the New York Fed, and of course his comments after a meeting in the Oval Office yesterday and Chair Yellen, Secretary Yellen's discussion of inflation.
Yep, she says she got it wrong last year. Tom Keene, co-anchor of Bloomberg Surveillance, thank you so much. Now, on the subject of the Fed, he was just talking about Bill Dudley. I am also watching the Fed today for a number of reasons. One being that QT is actually starting. We've talked so much about it, but until today, the Fed had not actually started rolling off that $9 trillion balance sheet, but that is what begins today. You're also going to get the Beige Book out of the Federal Reserve at 2 p.m. New York time. It, of course, reports on regional economic conditions, and we'll be getting more more Fed speak today. New York Fed President John Williams and St. Louis Fed President Jim Bullard will be talking. So how much will they echo what we heard from Christopher Waller earlier this week about 50 basis point hikes until inflation is closer to 2%? And who knows how far away that is, Matt?
Yeah, absolutely. So very important stuff to watch. I'm watching the work from home beat right now. You know, a few years ago, guys stopped wearing ties, ditched the jackets. I've noticed lately nobody shaves anymore, but now people just don't come to the office, and that makes Elon Musk really mad. It makes a lot of middle-aged white guys super angry, especially if they're bosses. And he's reportedly sent a note to his employees saying, if you don't come to one of Tesla's main offices for at least 40 hours a week, and satellite offices don't count, then go find a job somewhere else. He says they should pretend to work somewhere else, defending this on Twitter. The funny thing is that study after study shows that people who work from home actually put in more hours and dedicate more of their life to work. But bosses just don't want to believe it.
It's hard to switch off, apparently. Yeah, I mean, Elon Musk with strong views. Who'd have thought it? Let me get to what I'm watching today, which is a couple of European political developments. I'm watching what's going on in Denmark. In Denmark, they are voting today. They're going to the polls to vote on joining the European Union's defence pact. So this is not NATO, but the defence pact that is part of EU membership. They have traditionally shunned deeper integration over in Denmark, and they have had an opt-out for this since 1993. So interesting to see whether what is happening in Ukraine brings them back into the fold there. Also watching Croatia. It's going to find out whether it's in good enough shape economically to become the Eurozone's 20th member. We will get the verdicts of the ECB and the European Commission today. That is it for Early Edition. Surveillance is right ahead. This is Bloomberg.